Did you know you actually don't pay taxes on every dollar that you make? You probably did because you know there's pre-tax medical insurance and flex spending against your paycheck. But the government also gives you something else to reduce the amount of income subject to tax. It's either your standard deduction or your itemized deduction. So the standard deduction is just a set amount that is indexed each year, goes up slightly each year, that you get even just because. So for singles in 2020, that amount is $12,400. For those married filing joint, it is $24,800, and if you're a head of household, it's $18,650. So you get those. If the things that the IRS considers itemized deductions add up to more than that, then you would choose to do your itemized deductions. Now, the things that are included for the most part in itemized deductions for most people are medical expenses, state taxes, real estate taxes, mortgage interest, and charitable contributions. For medical expenses, the total unreimbursed medical expenses is only deductible to the extent it exceeds 7.5% of your income. That's a pretty high threshold, so I always tell people I hope you never have to take it, but if you had a really tough year, make sure you add them up because you may be able to get some benefit from it. As far as taxes, the state taxes and the real estate taxes, it doesn't matter what year they were assessed for. It's whatever dollars you paid out during the calendar year for the tax return that you're preparing. And currently, the most you can deduct on a tax return for taxes, no matter how much you paid, is $10,000. For mortgage interest, if your mortgage was taken out before 2018, you can deduct mortgage interest up to $1 million of outstanding principal. And if you took it out after, the cap is $750,000 of outstanding principal. There is a notation on the form that shows your mortgage interest that shows that, so it's pretty easy to figure it out. And then finally, charitable contributions. So you can deduct cash contributions made to qualified 501c3 charities. Now, please keep in mind that GoFundMe is not a qualified charity, and political contributions are not deductible at all. Everything else, though, you should have a receipt. You can include those in your charitable contributions. And then don't forget about your non-cash. It's always great to clean out your house and give it away because someone really does need those goods, and you are allowed to take a deduction for the thrift shop value of them. The government makes you determine what there is, and there are some websites and apps that can help you do that. If those add up to more than $500, there is an additional form to complete with a little more details on your non-cash contributions, but don't let that stop you from taking them if you really did clean out your house and give a lot away. And then this year, there's something really great for 2020 and 2021. For the first time, even if you can't itemize, you are entitled to deduct up to $300 of cash, not goods, and not donor advised fund contributions, but cash contributions on your tax return, even if you don't itemize. That is $300 whether you file married or separately. But for 2021, they did change that. So if you're filing an married filing joint filing status, you can deduct up to $600. And that's it. One last thing though, if you can't itemize, make sure you actually look at the instructions for your state return because many of these items are deductible on a state return even if you don't take them on your federal return. I'm Lisa Neisser and I'm ready to take on taxes together with you. If you liked this video and found it helpful, I hope you will click the like button on it and consider subscribing to my channel. If you would like ongoing tax tips when there's something helpful to share with you, the link to sign up for my email newsletter is in the comments. And don't let taxes scare you. Let's take them on together and let's become smart taxpayers.